Welcome back. Now, shoppers are tightening their purse strings. That's as retail sales continue to decline in 2024, slipping 0.8% year-on-year in February. The largest negative contributor to the print was retailers in textiles, clothing, footwear and leather goods. And joining me now with greater analysis on the data is Chief Economist at Investec, Annabel Bishop. Thank you so much for your time, Annabel. Yeah, we have to backtrack here. We're in April now, but we're looking at retail sales in February, which declined 0.8% year-on-year. Was this a surprise, considering that we did see inflation ticking up to 5.6% in February? And I mean, that's still, very close to the top end of the SARB's target range.
Yes, and I think, you've already hit the nail on the head there. It's inflation. That really is the key concern here. We saw real incomes. And of course, as we know, that is incomes adjusted for inflation. Excuse me. So taking inflation out of the equation, and we saw real incomes in February drop. And of course, that negative outcome obviously had an impact on the overall February figures. Let's not forget as well that January and February are both months in which consumers are still suffering a bit of a hangover from the festive season. So that also came into play.
Yeah, don't I know it, Annabel? But just looking, I mean, those monthly movements are quite interesting because from November to December, we saw a monthly increase of 1.4%. And then in January, we saw a monthly decrease of 3.2%. And then now in February, a monthly increase from January of 0.4%. Would you say that maybe just looking at the decrease in January and now the slight increase in February, that maybe things are starting to normalize a little?
They do tend to pick up a little bit as we, get through the first quarter. But of course, let's not forget as well that inflation rose in February to 5.6% from 5.3% in January. And of course, obviously 5.1% in December. So there's been upward pressure on consumers there as well. We also have elevated interest rates, and of course unemployment is very high in South Africa, along obviously with the fact that we also have weak economic growth. So overall, consumers are still under considerable financial pressure.
I know that looking at these figures, that clothes were the biggest negative contributor to this February print, but would you say that it's maybe still better off than other areas, for example, hardware, paint and glass?
Look, I think, the big winner here was general dealers. And, the story is that consumers are really spending on necessities. We saw a little bit of a positive contribution coming through from food, tobacco, alcohol from specialized stores. Essentially also, people, maybe dialing down a bit on luxuries into those types of necessities, but still at good stores. But I think, the bottom line essentially here is that people did suffer. And of course, you see that coming through in the hardware area, you see that coming through in the clothing areas. And of course, we would expect to see a bit of a pickup later in the year. We've both got the two-pot retirement system to look forward to. People can draw out some monies in the fourth quarter potentially. Also, of course, as well, we're hoping for an interest rate cut down the line.
I mean, just before we get to, the second quarter where there have been expectations of interest rate cuts, just, looking to March, because now we did have a cooling down in the increase of consumer prices as we saw today for March. Now at 5.3%. So could we maybe expect a little bit of a boost in retail sales, or maybe that's also still too hard of a call to make?
I think we could see a little lift in March. And of course, the concern we do have around the weather in South Africa is that we did see those very hot periods in February and through March. And of course, that hasn't reflected yet fully in the inflation numbers. So while they came down in today's print for the month of March, there is a lag of 1 or 2 months between what happens at the production level for agriculture in South Africa and of course what's reflected on the retail shelves for consumer or consumer price inflation. In fact, I had a look at the February producer price inflation figures for food, and there was definitely a significant rise. So the good news is that food price inflation at the producer or agricultural level is coming off a very low rate. It's around 1% in January and has just risen to 3%, or near 3%, 2.8% in the month of February. And of course, March, you'll expect to see it pick up a bit more. None of that's yet at the 4.5% mark, but it bodes for potentially higher pressure on food price inflation. And of course, the drop in food price inflation today in the CPI was one of the reasons why the overall outcome moderated somewhat.
All right. Well, let's get into the second half because, I mean, there have been interest rate cut expectations factored in there. But, I mean, just things locally also still look shaky because you have the Fed commenting that they're not really comfortable with the trajectory of inflation at the moment. So just looking at the trajectory of inflation, where it's still between 5 and 6% here in South Africa, it also seems that expectations of an interest rate cut keep on moving further and further down the line. Would you say that you are optimistic or cautious, or maybe just cautiously optimistic on the consumer position and also retail sales going forward?
We're definitely cautiously optimistic. Unfortunately, you're quite right in the fact that you're saying that expectations of interest rate cuts have moved out, both in the United States and South Africa. We originally had expected a cut in July. Then we pushed that out to September. Of course, that's a month when CPI inflation is likely to reach 4.5%. But listening to the South African Reserve Bank governor, of course, at the last meeting, he reiterated this. He's looking for inflation not only to reach 4.5%, but to average around that or be at that rate for a sustainable period. And that may actually indicate to us that instead November could be the month in which we get an interest rate cut, because we need a few months of obviously 4.5%. But unfortunately, the September inflation is only published in October, and that's still not be enough. Number of months running at 4.5%. So I'd say the risk is that we don't get an interest rate cut at all in 2024 for South Africa. And of course, that's not a cheering prospect. So these are the risks we're facing at the moment. Hopefully, we start to see a bit of a turn in some of the key drivers for inflation. Of course, we do know that's food and fuel prices. So oil prices have been quite elevated this quarter. Perhaps they'll come down as we move into the next quarter. There's obviously been some impact of geopolitical risk in there as well, and worries around supply.
Yeah, indeed. Well, thank you so much for giving us your time and your analysis there, Annabel. Appreciated. That was Investec's Chief Economist, Annabel Bishop.